How's the market treating your fund? What's
look, our process is raising cash at the moment. So cash is obviously a drag on returns when the stock market's going up because you return 2%.
Yep.
And so while we've outperformed significantly and materially every year since inception, in the last 3 or 4 months we haven't. And that's a function of the fact that we've got a lot of cash. And over the course of tonight's program we'll talk about why I think that's an appropriate position to have.
Because I think that's a challenging theme, the cash thing. Well, I've got this idea in my head, and I want to share it with you. A lot of people, when I go and talk to presentation seminars about people who've got so much in cash, I look at the self-directed and they've got, it's 27, 30% in cash. The total cash bucket as of end of June was $775 billion in term deposits for the 4 majors. That doesn't include ING. That doesn't. And it's just going up. It started at 2 years ago. It was 400. It's now 700.
So perversely, lower interest rates is having the opposite effect on savings. The other thing is, the common complaint that you hear from, and I think it's a simplistic argument, and Rudy, you talked about it. Investors will say, well, I'm not paying you to be in cash as a fund manager. The reality is, no, you're not. But if I said to you, look, the stock market's fallen 30%, I haven't lost a cent actually. My fund manager got me out just before. Do you want his phone number? That phone number would suddenly be very valuable to you. Sure. So you're paying a fund manager who's at the coalface to decide when to protect your capital and when to grow it. Sure. And that's our job. Now, perversely, and we talked about this, we alluded to it just a minute ago, central banks buying bonds to lower the long bond rate and central banks or governments or central banks lowering cash rates, it's not stimulating economies anywhere in the world. In fact, in Denmark, where rates have been negative for the longest, savings as a percentage of GDP is going up, and spending consumption as a percentage of GDP is actually declining. So perversely, it's doing precisely the opposite. In fact, negative rates is a quasi-tightening. It's actually having a tightening impact on behaviour rather than a loosening impact. And I wonder what will happen if eventually they go, hang on, this actually isn't working. Not only do we need to normalise rates because we want to have some bullets in the barrel, so to speak, if there is a recession, but it's actually a flat yield curve disincentivises investing long term for businesses, and it disincentivises spending.
I think Roger's right on one hand. I mean that part of the story is correct, I think, and I think that's been pretty much established now. I do think that the other part is a problem. I don't think central banks can go like, oh, let's normalise interest rates.
That would cause an enormous... Exactly. They would cause the recession that we would have had in 2009 that we didn't, because we delayed it by quantitative easing.
We didn't. The rest of the world had the recession. The rest of the world hasn't got out of that recession.
When I say we, I mean financial markets, central banks.
I hear what you're saying. The savers, the liability managers are being dramatically punished. The way I think about it is that corporate world haven't done their job. Now, political world haven't done their job, but corporate world hasn't done their job because they haven't borrowed the money to invest in the business.
Well, they actually have.
Because they've bought shares. They haven't bought money to invest in the business.
No, and that's the difference.
They pay dividends.
Borrowings have gone through the roof from 2010 to now, but 90% of that debt has been employed for buybacks, mergers and acquisitions and special dividends. So only 10% is used for capital productivity improvements or productivity capacity increases.
So the point becomes then that the people that live off the dividends, the people that you were saying are not consuming, not spending, are relying on the corporates borrowing to pay the dividends. That's the circular reference. That's the problem. And no one's got a policy to fix that. Well, no one can say I can lift rates, because they can't, because they'll hurt all the borrowers.
So the 3 ways that companies can grow is they can retain earnings, they can retain earnings and reinvest, and they haven't been doing that as much as they used to. Since 2011, the payout ratio in Australia, for example, has gone from 55 to 80% for the ASX 200. So there used to be 45% retained and reinvested for growth. Now there's only 20. So the other way they can do it is to issue new shares, but they've been using debt to buy back shares. So that would look bipolar if they actually went out and started issuing shares again, and which they should do when shares are expensive, not buying them back. And the other thing, the other way they can do it is borrow money. And they have been doing that, but they've been doing it, as I said just a minute ago, to buy back shares. So prices are elevated. We've now got, for example, utility companies in the United States that are 3 standard deviations from the mean on an enterprise value to EBITDA level.
Now, just stop there. We're going to get to it.
So EV to EBITDA, enterprise value is market capitalisation plus debt divided by operating cash flow effectively, earnings before interest, tax, depreciation and amortisation. And on that basis, when you look at utility stocks, which have been the greatest beneficiary of the migration to higher risk assets, if you like, because of their stable income and their long duration. Remember, the longest duration assets are the most sensitive to interest rates. So as interest rates go down, they go up the most. So Sydney Airports, Auckland International Airport, Transurban, the US utilities. Those US utilities now are trading at 3 standard deviations above the mean. 1 standard deviation is dangerous. 2 standard deviations is like once every 400 years, and 3 standard deviations is once every 1,400 years.
Folks,
it's extreme.
It's extreme, and
it's extreme.
And what he means here is the model is wrong.
Can I just one more thing, Rudy? Sorry, forgive me, and then I'll be quiet till the next ad. All right, very quick. So when we discount cash flows, when we're valuing businesses, what we do is we use the weighted average cost of capital, right? Which is just the interest rate times the amount of debt, the proportion of debt, multiplied by the cost of equity times the proportion of equity. So in your capital calculation. Now, these companies are all debt. So what we're effectively doing is mostly rewarding more the most highly indebted companies.
No, we have to talk
when
about
interest rates are at a 300-400 year low.
Very interesting point.
Yeah. Any thoughts on helicopter money versus QE?
Well, whether
the effectiveness is what John's saying.
Well, we had it in Australia with the school building revolution. Kevin Rudd threw money at. I was on one of the.
I thought that was fantastic.
I was on one of the school committees to build.
I thought it was great.
It did. I mean, a lot of money was wasted. A lot of stuff was overpriced, but
it was what was it? They did an assessment. It was 19%, and I built a house.
It worked. Yeah.
19% is a bargain. I mean,
okay. Well, we built 4. Primary school rooms at sort of something like $6,000 a square metre, which is what you pay for a luxury house. And these were, fairly simple rooms. But that aside, it worked. Yeah. It kept us out of recession, arguably.
And there is also a question of good debt and bad debt. And the bad debt, no one ever thinks of good debt anymore.
The 2 options for investors, what's important to understand is this, I believe. There's 2 options. One is another round of QE, and I believe markets would then just completely lose faith in central banks. And that would see, a flight to quality, and you'd get Spain interest rates going up, and you'd get Italian interest rates going back up again. Or the alternative is you end up with helicopter money, which actually could work, stimulates the economy, and the long end of the yield curve starts going up again. And when we're discounting NPVing future cash flows, the valuations of assets come down, and so the stock market comes off.
We have another caller.
Okay, so very quick, I just want to summarise all this discussion that we've had about interest rates.
People are trying to follow what we're talking about.
Here's some interesting facts. Between 1960 and 1981, interest rates in the United States went absolutely bananas. They went through the roof for 20 years. And during that time, the S&P 500 returned 2.5% per annum. Between 1982 and 2001, the next 20 years, interest rates collapsed. And in that time, the S&P 500 returned 14.7% per annum. So you doubled your money almost every 5 years. Since then, though, what's happened is interest rates have continued to decline, but the equity market risk premium, what we're demanding over interest rates in order to invest, has compensated, so the total discount rate has been flat. And in that environment, we've returned to sort of 3% per annum from the S&P 500, including the most recent rally. And so my view is it actually doesn't matter whether interest rates stay low for a long time or start climbing. But one of those 2 scenarios is the scenario that's going to play out. Low returns from the S&P 500 or the broad stock market indices is almost certain. The only difference is one could be plodding along at low returns, and that's if interest rates don't move, and the other one is if interest rates do go up, and I'm in the long end, then you could get some sorts of corrections that might hurt people a lot.
It's the ageing demographic. That's a growth engine. So how do people feed to it? And I think that's what makes the equity market that much harder to work out.
We believe that one of the places investors can get what we call alpha, additional alpha in a low return environment.
So alpha is return. So movement of your
additional return, above the low new normal that everyone talks about, which I believe is completely abnormal.
It's completely abnormal.
But one of the things that we've done, for example, is last week we launched a fund called the Alpha Plus Fund, which is a market neutral fund.
What does that mean?
So market neutral means we've got a long portfolio and an equally sized short portfolio. We're going long companies that we believe are high quality and have factors that generate wealth, and then we're going short the companies that have factors that actually destroy wealth. And so it doesn't even matter if the stock market falls, as long as the bad stocks that we've shorted fall more than the stocks that we've gone long, we generate a positive return. Sorry?
Short Woolies?
No, we're not actually. It's already had a big move down, as you know. I've talked about it for years now.
Yeah, absolutely.
We sold it at $33 in November 2014, I think it was.
Right. What are you looking at now? How's the offshore fund going? What's happening with that?
Yeah, look, it's done better than our peers, but it's had a tough time. And that's partly a function of the fact that the Aussie dollar, it's unhedged, and the Aussie dollar, as you know, has gone from 68 cents to 78 cents. That's a big part of it. And what we also saw was that China stimulus earlier in the year caused a lot of the resource and material stocks to rally hard, and we weren't in those.
Yeah, right. And so you've got, and I'll finish with you, then I'll go to Rudy because I need to get your thoughts. But you've got a market neutral fund, then you've got your normal fund.
Yeah, so we've got the Montgomery fund and the Montgomery private fund, which are domestic, long only, just traditional equity funds, and they've done extraordinarily well. Then we launched the global long only fund, which is the Montgomery Global Fund, and Montica, Montica is a long short.
Yeah, right.
But and I don't want to get too technical.
How do you keep on top of all that?
It's variable beta, and what we like about that one is, in this age of disruption, it's really, really hard to pick the winners, but it's easy to pick the losers. And so we're shorting those.
You wrote an article on guidance, and you weren't happy that.
I proposed the idea.
Which isn't going to happen because the ASX won't let it happen. But
I proposed the idea that the financial world and investors would be better off if companies didn't give guidance. Because look, the bottom line is this, and I'll summarise the whole article this way. When a company...
It's in LinkedIn, folks, so it's not that long you can read it, but go on.
Yeah, just type in Google, Roger Montgomery guidance. When a company proffers guidance, the temptation is to pull out all stops to meet it. And the temptation is too great sometimes to be aggressive with accrual accounting to actually meet that number. And in the long run, what you're doing is often you're borrowing growth from the future to deliver short-term numbers. And when I see, and I talked about this during the break with you guys, but when I see an analyst say the company missed our estimate, as if it's the company's fault, I question it. I say, well, actually, didn't you do your work properly? And what ends up happening is if companies didn't give guidance, then it would be much easier for investors to see which companies are actually the stable, easy to predict businesses and which are the more volatile businesses. And that would bear out, and then people would attribute the right discount rates to value those things.
Yeah,
there's probably been one sector of the economy that's been going very well, and that's the residential construction industry. Everywhere else it's been really tough. So what we've seen is a consolidation in that industry, to the big brands. So, for example, Dick Smith's collapse, JB Hi-Fi produces a really great result. They collect market share and they generate great returns, and we've seen it with Bapcor, Burson's, for example. They're in Burson's Automotives. They're in a duopoly, and we're seeing more and more of that consolidation of industry in Australia.
That's the way the economy's going. Look, it's been a great show.